In 1817, Thomas Jefferson made a request. He wasn't asking for land, he wasn't asking for power, he was asking for a book, and he was denied, not by a king, not by Congress, not by a foreign enemy. He was denied by a private guild, a former president of the United States, blocked from accessing a rulebook. That only happens when what's inside carries weight, because you don't restrict access to something insignificant. You restrict access to structure, the frame they gave you. You were taught that America evolved naturally, primitive systems replaced by better ones, loose structures replaced by efficient institutions, local economies replaced by modern markets, chaos replaced by order. But what if that story skips a step? What if a working system wasn't abandoned because it failed, but because it worked differently? What if it distributed power in ways that didn't scale upward? What if it resisted consolidation? The lost trigger. I own a chair built in the 1840s, nearly 200 years old, still level, still strong, solid oak, hand-cut joints, no wobble. Most furniture today won't survive 10 years. That's not an accident. That's incentive. When durability stops being profitable, durability disappears. When replacement becomes more profitable than longevity, design changes. And once you understand that incentives shape products, you start asking what incentives shape systems. The guild model. In 1724, the Carpenters Company of the City and County of Philadelphia was founded. It operated under a guild structure. Master builders. 7-year apprenticeships, standards enforced collectively. Inside their rulebook were mechanisms most people today have never heard of. Fair pricing was enforced. Costs were standardized. 2 independent measurers verified work before payment. No unilateral inflation, no surprise markups. An economy where pricing manipulation was structurally limited. Craftsmanship wasn't just aesthetic, it was regulated. Trust wasn't abstract, it was institutionalized. This wasn't chaos, it was decentralized order. Trust as infrastructure. Credit existed, but relationally. Neighbor to neighbor, craftsman to client, sometimes open for years. A blacksmith might extend trust to a farmer until harvest. A carpenter might complete work before full payment. There was no corporate intermediary inserted between every transaction. Trust was infrastructure, and when trust is infrastructure, scale behaves differently, because scale requires abstraction, and abstraction requires distance. The structural shift. Then came 1863, the National Currency Act. Money issuance became tied to federal government bonds. To create currency, banks had to purchase government debt. Currency and debt became structurally linked. Soon after, local banknotes were taxed out of existence. Decentralized currency faded. Centralized banking rose. Money became standardized. Portable, national, but also consolidated. The system shifted from community-backed value to institution-backed value. One system operated on relational verification. The other operated on bond-backed issuance. Both functioned, but they functioned differently. The Homestead sequence. 9 months earlier, another law passed. The Homestead Act. 160 acres of land. Free, but building required capital. Tools, lumber, livestock, seed. Opportunity was offered, but participation required borrowing. Land without infrastructure is potential. Infrastructure requires financing, and financing requires lenders. When land distribution intersects with centralized credit, expansion becomes debt-dependent. Ownership and obligation begin to intertwine. The company-town model. As industrialization accelerated, company towns spread. Workers were paid in scrip, spendable only at company-owned stores. Housing owned by employers, supplies purchased from employers, wages recycled back into the same entity. Debt accumulated. Leaving became difficult. One system distributed power horizontally, the other concentrated it vertically. In a guild economy, the master builder was accountable to peers. In a company town, the worker was accountable to ownership. The architecture of obligation changed. Identity formalized. In 1870, the United States conducted its first census, listing all Americans by name. Before that, tracing identity at scale becomes fragmented. Around the same era, money centralized, labor industrialized, identity formalized. Individuals became data points, taxable, trackable, measurable. Guild systems tracked reputation locally. Centralized systems tracked identity nationally. Scale requires records. Records require standardization. Standardization requires authority. Incentives. Rewrite culture. When durability fades from furniture, we notice. When durability fades from systems, we don't. Because systems don't break dramatically. They transition gradually. Guilds faded, apprenticeships shortened, pricing standardization loosened, financial intermediaries expanded. Insurance companies inserted themselves between trust and risk. Credit scoring replaced reputation. You no longer borrow based on who you are known to be. You borrow based on a number. Numbers scale, relationships don't. A modern contrast. In certain Amish communities today, medical costs are pooled collectively through church-based mutual aid systems. There is no corporate insurance provider processing claims, no complex billing codes, no shareholder profit margins built into the structure. When someone falls ill, the community gathers funds directly. Families contribute according to ability. Church leaders coordinate support. The goal is coverage, not revenue. There are no monthly premiums in the conventional sense, no deductibles designed to discourage use, and no executives extracting value from the transaction. The system operates on shared obligation and reputational trust. If a barn burns down, neighbors rebuild it. If a child needs surgery, neighbors help pay for it. To maintain this structure, Amish communities formally opt out of federal programs such as Social Security and Medicare. That choice is not symbolic. It requires legal autonomy and collective discipline. Opting out is rare because most communities rely on centralized safety nets. The Amish did not move backward in time. They preserved a parallel economic model, one where risk is distributed horizontally rather than managed vertically. It is smaller in scale, yes, but it functions consistently within its boundaries. Back to Jefferson. So, return to 1817. Jefferson asked for a guild rulebook, and he was denied. Inside that book was proof that fairness could be systematized without central consolidation, that pricing could be verified without distant regulators, that apprenticeships could enforce quality without mass production. Within decades, that system diminished, replaced by industrial finance, replaced by standardized currency, replaced by corporate scaling. Was it inevitable? Maybe. Was it neutral? That's harder to answer. The oak chair. That 1840s chair still stands. Built before consumer credit expansion, built before planned obsolescence, built under a system where reputation traveled slower but lasted longer. You weren't taught this transition as replacement. You were taught it as progress, as evolution. But evolution doesn't always mean improvement. Sometimes it means consolidation. Sometimes it means incentives shifting away from durability in objects and in systems. The quiet replacement. Guild economies weren't perfect. They excluded outsiders. They limited competition. They weren't utopias, but they distributed enforcement locally. They embedded pricing ethics into structure. When centralized finance replaced them, efficiency increased. So did scale. So did abstraction. So did distance between decision makers and daily life. Most people didn't notice, because change happened across decades. No single moment, no dramatic announcement, just laws, incentives, transitions, until the old system was memory. The question: what happens when durability is no longer profitable? What happens when credit requires debt at scale? What happens when identity becomes data? You don't need to romanticize the past to question the present. You only need to recognize that systems are designed, and when systems change, someone benefits. Jefferson's denied request wasn't about curiosity, it was about structure, because inside that rulebook was a different way of organizing value, and within a few generations that way faded. You were told it evolved, but evolution doesn't always move toward fairness. Sometimes it moves toward consolidation, and sometimes the replacement happens so gradually you never notice.
What if I told you that the world's most powerful banks, the multinational corporations that dictate global trade, and even the billion-dollar tech monopolies shaping your future, are following rules written almost 700 years ago? Rules created not by modern economists or Wall Street elites, but by blacksmiths, bakers, and stonemasons in medieval Europe. Today, we take for granted the idea of corporations, patents, trade secrets, and closed-door cartels. But what if all of this, from Wall Street to Silicon Valley, was never an invention of capitalism, but a replication of medieval guilds? This is the story of how medieval guilds became the blueprint for today's financial powerhouses, and how the systems they engineered still run the world, long after the guilds themselves disappeared. But here's the twist. They didn't truly disappear. Their structure survived, just with different names. To understand the foundations of modern finance, we need to go back to the 11th century, a time before stock markets, before central banks, before corporations. Europe was rebuilding after centuries of instability. Trade routes reopened. Caravans, ships, and merchant caravans moved again. The economy was waking up. But there was a problem. There were no rules, no standards, no quality control, no banking, no systems of trust. A bad batch of grain could kill a town. A dishonest merchant could bankrupt a region. A counterfeit coin could collapse a city's economy. Then something happened. Craftsmen, traders, and merchants began to form secretive groups, not unions, not companies, something else entirely. They called themselves guilds: blacksmiths, stonecutters, glassmakers, shipwrights, butchers, bakers, bankers. Each guild operated like a closed society, with hidden rules, secret rituals, and a goal: control the market. They had oaths, they had ranks, they had monopolies, and they had enforcement. If you wanted to work, you joined them. If you challenged them, you were ruined. If you betrayed them, you disappeared. Does any of this sound familiar yet? Think about Google's search dominance, Coca-Cola's secret formula, Apple's closed ecosystem, pharmaceutical patent monopolies, cartels manipulating oil prices. These are not coincidences. This is a pattern, a blueprint. How guilds were born. The earliest guilds began for one simple purpose: control who could participate in the economy. To join, you had to be approved. To grow, you had to obey. To innovate, you needed permission. The guilds built a system: apprentice, unpaid labor, years of training, journeyman allowed to work, but supervised master, full member, with voting power. Grand Master ran the guild, controlled the trade. This wasn't just a work structure, it was an economic pipeline, a pipeline still used today. Modern parallel: intern gives employee, gives manager, gives CEO, gives board of directors. A medieval model copy-pasted into the corporate world. And this structure did something revolutionary. It made wealth predictable. Guilds guaranteed income for members. They set prices. They controlled supply. They controlled demand. They eliminated competition. They turned local industries into private monopolies. Today we call that oligopoly. From craft networks to financial machines, as guilds grew, they discovered something even more powerful than trade. They developed confidential training manuals, secret formulas, protected techniques, testing systems for quality. Branding marks the origin of trademarks. If a medieval shoemaker guild caught you copying their design, you could be fined, banished, or worse. This was the birth of intellectual property law. Guilds also invented standardized weights and measures, regulatory boards, licensing requirements, market inspections, capital pools for investment in Venice. Merchant guilds pooled money to insure ships. This eventually became maritime insurance, the foundation of modern banking. In Florence, guilds created the first credit networks. They created bill of exchange systems, paper that represented money centuries before banknotes. In the Hanseatic League, merchant guilds controlled trade from London to Novgorod. This was the first multinational trade corporation. While kings ruled the land, guilds ruled the economy. When guilds became too powerful, but success breeds fear. By the 14th century, guilds controlled food supply, trade routes, labor markets, pricing, manufacturing standards, access to capital. They were collapsing governments, toppling monarchs, funding wars. Guilds didn't just serve the economy, they ran it. European rulers realized something terrifying. They couldn't tax guilds, they couldn't regulate them, they couldn't stop them. So they tried to replace them. How they legalized a new concept, the chartered corporation, a legal entity granted by the state, with monopoly powers, just like a guild, but controlled by the government, or so they hoped. But instead, something else happened. Corporations learned from guilds. They copied their structures, their secrecy, their monopolistic behavior. Guilds weren't destroyed. They were digitized into law. The world had entered a new age, the age of corporate guilds. How guild DNA survived. Governments tried to regulate economic power, but every attempt failed. Anti-monopoly laws. Corporations found loopholes. Open competition, buyouts and mergers restored control. Banking limits. Banks created shadow markets. Labor rights. Outsourcing and automation bypassed laws. It turns out, the guild blueprint worked too well, because it was based on something that never changes, human nature. People will always organize to protect wealth, to limit competition, to control access. The names changed, the strategies evolved, but the blueprint remained. You may think guilds are ancient history, but listen to this. 10 companies control nearly every global food brand. 3 companies control 80% of the US internet. 5 banks control half of the world's financial assets. Big tech employs a closed pyramid training system. Pharma monopolies mirror medieval apothecary guilds with patents. Apple's walled garden, a guild. Goldman Sachs hiring exclusively from certain universities, a guild. Disney owning 40% of Hollywood box office share, a guild. These aren't coincidences, they are continuations. The same methods, the same incentives, different logos. Guilds never vanished. They evolved. From stone workshops to glass skyscrapers, from quill contracts to encrypted trading algorithms, the medieval economy didn't die, it scaled. Conclusion 3 takeaways and final message. So what can we learn from this? Takeaway number 1. The economy has always been controlled not by markets but by networks. Takeaway number 2. Monopolies are not a glitch in capitalism. They're the original design. Takeaway number 3. If you want to understand the future, study the past, because history doesn't repeat. It rhymes with compound interest. And here's the most important question. If corporations are the guilds of today, what comes next? A new evolution? Or the end of the game? Maybe the next financial empire won't be built in boardrooms, but in blockchain networks, DAOs, decentralized guilds, digital monopolies without borders. Are we about to witness the return of the guild age? If this video changed how you look at history and modern finance, subscribe, because this is just the beginning. Comment below if you want a part 2 on how guild tactics appear in big tech, Wall Street, and global trade today. And remember, the past is never dead. We're living in it.